let's talk about the Fibonacci sequence. You can Google it, right? Fibonacci numbers are named after the Italian mathematician Leonardo of Pisa, later known as Fibonacci. His 1202 book, Liber Abaci, Fibonacci introduced the sequence to Western European mathematics, right? Although the sequence had been described earlier in Indian mathematics as early as 200 BC in work by Pingala on enumerating possible patterns of Sanskrit poetry from syllables of two lengths, right? So all of that stuff, okay, Benny, how does this apply? What is this madness? So if we go back here and we go and we look at images, okay, you can see that the Fibonacci sequence plays out. It's a mathematical pattern. The great thing about math, right? And I wish somebody would explain to me early in life instead of just telling me, hey, you need to do this class if you want to pass and go to the next grade. Then I probably would have bought into it a little bit more. But nonetheless, I've learned it now, and I am a fan of the math. So because math helps us find the patterns, right, in everything in nature, right, especially on the technical chart. So if you look here, you can see that the patterns, right, whether it's the scales on the fish, you look at this scale, this shell here, right? Look at this, flower petals, you name it, staircases, surgeons, when they do plastic surgery, right, they use Fibonacci ratios, right? And I know a lot of people have heard about that, right? So you guys see the pattern. 1 + 1 = 2. 1 + 2 = 3. You see that how that goes? 2 + 3 = 5. 3 + 5 = 8, and so on and so forth into infinity. So the main thing that you need to know, right, is that it's all about the pattern. It's all about patterns. It's all about the math, and the Fibonacci tool, the retracement and the extension tool really helps us to understand that. But in order for us to move forward today, right, and we're looking at this is a pound, right, the Great British Pound versus the US dollar chart, okay, on a daily time. Each one of these candlesticks on the chart equals a day, a day's worth of price action in the market, okay? So in each candle, right, we all can agree that in a daily candle, which measures the price action, right, of the candles, it measures the open, the close, the high and the low, right? So that day, in this example, we can all agree that in a daily candle, we have more price action and data than we do in a, say, for example, 1 hour candle, right? The higher the time frame, the higher the levels, right? The higher time frames control the lower time frames. And that's very, 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 very important. We like to say all the time in the circle that the parents are supposed to control the kids, right? And that each lower time frame is what we call a fractal image of the higher time frame, okay? So if you think about it, if you think of a tree, right? Everybody pictures this. If you think of a tree, okay? Trust me, I'm going somewhere with this, all right? If you think of a tree, you look at a huge, big old tree, but then if you look at the branch of the tree, it's really just a smaller replica of the larger tree itself. And then if you look at the twig on the tree branch, that twig is just a smaller replica, okay, of, right, that tree branch, okay? So think about that. It's fractals, right? And this is how we're going to get into these waves. So if we're looking at this chart, right, I don't care if you're brand new or you've been trading forever, all right? Does this market move? Does it move straight up and down, or does it move in waves? It moves in waves, right? So we have to agree on that. Is all it is for now, okay? We have to agree that this market that we see right now is moving in waves, right? It has moments in time where price actually can move straight down, impulsive moves, usually around fundamental occurrences, okay, which we just covered. But all in all, it pretty much moves in a wave, okay? And the Fibonacci sequence is going to help us, listen to me closely now, measure those waves, okay? So we say that the key in this whole thing is knowing when you're looking at a technical chart. All right, we got to know a few things. We want to try to establish direction, where to get in and where to get out. All right, and the Fibonacci sequence and the way we use it helps us to measure all of that. So Benny, why do we use that, right? Because it helps us with our direction, where to get in and where to get out, in addition to, right? We like saying that the fibs are the tuxedo on the price action, because at the end of the day, right? It's really fundamentally at its core about support and resistance, right? And understanding, right? So let's work through this. So if we all agree that the market moves in waves, but we say that this market moves in ABCD waves, like so, like this, in an uptrend, okay? And we say that in a downtrend, it does the same thing in the opposite direction, like so, okay? It moves in waves, right? Now this is clean, this is an example, right? Okay, but at the end of the day, we can see that it moves in waves. And we say that it moves in ABCD waves. So we, here, ABCD waves. So look, here's our A, here's our B, here's our C, here's our D, which represents completion, right? For that wave cycle. Here's our A, here's our B, here's our C, here's our D. So how does this form? Because when we look at candlesticks and we look at price action, right? They are just a visual representation, right, of the buying and selling habits of people, banks, institutions all over the world. It's a footprint, right, that they're leaving, okay? So they're leaving that footprint for us. And we're looking for the patterns in that footprint. That's why support and resistance is so important, because when you have a level of support, right, and you look back in the past and you see that there's holding, that's a price level where you have buyers. Hey, we like this level, we can buy. And then when you have resistance, we like this level, we can sell, okay? So how does this all form? So we agree, we've got an ABCD wave to the upside, ABCD wave to the downside. So let's pull in our levels of support and resistance, okay? So here, we've got support in which we call a floor, okay? This is our floor of support, like so. So support is what we're gonna call this. And then we have a level of what we call resistance, okay? That's our ceiling, okay? This is our resistance level. All right, we've got that. So when we look at price action and how it goes, so in order for us to have a floor, okay, or a support level, one of the key things that we use is that 5-candle combination to say, okay, this price is holding as a floor. So no, it's not just because price touched it, okay? We want to see, right, it gives us, right, that candlestick formations, because candlesticks are the sign language of the Forex market, or any market for that matter, right? It'll tell you what it's trying to do, okay? So we have a floor here, which means we have a swing low, okay? And what'll happen is you get buyers to come into the market and they start pushing price up. All right, everybody follow me. And it'll come to a point right here, 220, right? This number here, where you say, okay, we've bought to this level. So if I'm buying, I've made money. And then you have sellers, people taking profit, and it pushes the market down, okay? And this example is in an uptrend. And then what'll happen is it'll say, okay, a new floor eventually is established, right? So look, you got this move. Look at this move from 0 to 100% is what we're gonna look at this move. So it moved from the floor, 100%, formed a swing high, and then it pulls back, right? Profit taking occurs. The market moves back down, okay? This is the wave sequence, all right, that we look for. Then what will happen eventually, if that price wants to continue to push up and we start to get price trending, right? That uptrend, those higher highs and those higher lows, then what's gonna happen is price is gonna come down, right? A certain percentage, okay? And you all will see where we're going, and it'll create a new floor. And they'll say, all right, well, it's not as low as that last price, but this is a good price to start buying again. And it'll form a what? Another swing low, which is why this is important. So if it forms another swing low in the zone, that's forming another what? Support level, okay? So now we've got this new level of support because it formed a swing low. So we've got support at some level, at some point in time, okay? If the uptrend is going to stay intact, it's going to create a low within this price move that it made. From this 0 to 100% move, it's going to create a low. And then what'll happen is people will start buying again. And the price pushes up. It'll break this level of resistance. And this is what we call our push zone. And it pushes to, right, what we call an extension level, which in essence is going to form eventually another form of resistance, another ceiling of sorts. So we've got these levels. So what you can do, right, is we say, hey, you need to know direction, where to get in and where to get out. So if we go to the dealership, do we want to buy the car at the highest price or the lowest price possible? At the lowest. If I have something that I want to sell, if I had a car that I wanted to sell, a vintage car, do I want to sell it at the highest price or do I want to sell it at the lowest price? All right. So we all get this basic economic concept. All right. Buy low, sell high. In this example, in an uptrend, we can measure these moves. So this move here, this A to B move, A to B, C to D. We can measure this, right? So a price action move from A to B, we don't necessarily want to buy it at this level. We want to wait for it to come back down low as possible for us to buy it again, right? Because that's a high price in the market. So we want to figure out, well, how do we take advantage of this? This is where the Fibonacci comes in, because if the market moves in ABCD ways, right? And we know that it gets shady and it moves sideways and things like that. But ultimately, as you guys will see, it's moving in an ABCD way to completion. So if we want to be able to take advantage of this, how do I take advantage of this pattern, keyword, that is occurring in the market? The beautiful thing about the Forex market is it happens in repeatable patterns over and over and over again. So we use what we call the Fibonacci tool, okay? Mathematics, measure patterns, right? To measure patterns. And you see these percentages, and you see these are prices, these are percentages. Don't let it scare you. We're gonna break it down, okay? And these are retracement levels or pullback levels. And these are what we call extension levels. There is a correlation, patterns. It happens over and over again in the market, okay? So if I take this Fibonacci tool and I want to measure this move, let's pull it all together. Now, if you use it in TradingView, right, you're going to have it, or any other platform, you're going to have it as two different tools. You're going to have what they call a Fibonacci retracement tool, where it just gives you the retracement levels and the pullback percentages. And then if you want to make it and see the extensions, the correlating extensions, these price levels here, then you're going to have to use your extension tool, which you go like this, from low to high, back to low, and it'll give you the extensions, right? The beauty of the Smart Trader platform is, right, is they have the rights, right? They created the tool, the Smart Trader, the Smart Fibonacci tool, right? Which you'll see as we go through. They didn't create the Fibonacci tool, but their version of it, right? They have the patent on it, right? Where it gives you the retracement levels and the extension levels all in one tool. Now, so we use the Fibonacci retracement and expansion tool as well. So we're going to measure this. So if this, right, is a 0 to 100% move in the price action, I can use my Fib tool, which is this tool right here, and I can measure that like this. I can take it from my swing low, which gave me support, to my first, focus on that now, what I just said, because a lot of people learn it different, to my first swing high, right, which created my resistance, like this. And now we can start playing this ball game, okay? So what this does is it measures the price action and measures the wave movements, which helps gives us direction. It can tell us where to get in and where to get out of the trade. And this is how we use it. So I'm gonna pull this tool out. You say, Benny, what is all of this stuff? Okay, listen, it's very simple. if this initial move, okay, was a 0 to 100% move, we know that the market moves in waves, ABCD waves, to go back to the first question that we asked. So when this sell-off comes and the market gives back part of what it took, it's going to take back a certain percentage of the previous move. So if I've got an AB move and we've seen the price action move up, right? Price action has made waves and it moves up. I got my low, I got my high. I'm going to pull my tool out because I want to measure that. And what this is telling you, all this is telling you, is when this market makes this pullback or this retracement, depending on the language that you learn, okay, or inside return, okay, is the market taking back 23% of the initial move? Follow me. 38.2% of the initial move? Is it going to take back half of the initial move before the continuation? Is it going to take back 61.8% of the initial move, right, before it continues? Okay, and we all hear about this, the golden ratio and the Fibonacci sequence, but we're going to tell you why that is, right? It's kind of a self-fulfilling prophecy, and it helps us with our risk management. Is it going to take back 78%, 86%, or is the market going to retrace all the way back down and take back 100% of what it gained? So once it hits this level of resistance and it starts to pull back, how much is it going to take back? 38%, 50%, 61.8%, 78%, 86%. Or is it going to return to what a lot of us in trading, right? When it returns to that level of 100%, we start thinking what? Double bottom, right? Sometimes, okay? So this is how we use this tool. And people say, well, I know that already. That's good, right? That can shorten your learning curve, compress time frames for you, okay? But the way we use this is that based on the math, and the tool does it for you, based on how much that the market takes back after the initial A to B move, right? Based on how much it takes back, we can project how far it's gonna go. Say that again. Based on how far the market pulls back or retraces, we can project the potential in regards to how far the market's gonna travel. It helps us with our direction, where to get in, where to get out. So when you say, how did you stay in this trade for 300 pips? This is it, okay? This is it. No way you stayed in that trade for 300 pips, or no way you guys had a 100 pip trade on a 1 hour time frame. Well, this is it, okay? This is how we do it, all right? Based on these projections. Now, can you take profit all along the way at key levels? Absolutely, right? Or you can hold the trade, add to the trade, however you want to do it. That's all based on trading plan and strategy, okay? So based on this pullback, now, what we want you to think about in regards to these percentages, again, based on how far it pulls back, it can tell us a projection of how far it may want to travel. So what you want to think of these different levels, these are what we like to call our energy trampolines, because it's all about momentum, energy trampolines, all right? So based on how far it pushes back, pulls back, can tell us about the momentum going forward. So the cool thing about Smart Trader, but it has it color coded. So you've got these energy trampolines and they're color coded. So look, red, and then you see way up here where you have this red 1.618. So we know, right, and there's a caveat to it that we'll share with you in a little bit, but we know that anytime if price pulls back to any of these key levels in red, it has the potential for its final destination to be the 1.618D extension based off of the Fibonacci sequence and the ratios, right? The math is amazing. So if it pulls back to a 382, right? And then it continues, we know that it has the potential to go to the 1.618. Ultimately, it may dance around, it may move sideways, but ultimately, right, it can get to the 1.618. Okay, if it pulls to the 50% or the 618, we know it has enough momentum. If it U-turns, it's going to have enough momentum to where it can possibly get to the 1.618. So this is how we set up our entries and our targets. and how we're able to stay in the trades. Now, as you develop with the style, you may decide, hey, I want to take profit along the way, whatever. But let's get the key fundamentals down today, right? The method to the madness. But if price sells off and it pushes deeper to a 786 level, in other words, it takes back 78% of what it gained, it's going to have less momentum. So we adjust and shift our projection to the 1.27 extension. Okay, follow me close. If we get a deeper retracement and it takes back 86% of what it gained, then we adjust our TP level to the 1.18D extension because it's going to have less momentum. Now, does this happen all the time? No, but it happens a ton of times, right? Does sometimes the momentum get so strong on a pair fundamentally that it just, boom, blows through all projections? That's cool, right? But this is how the game works. If it pulls all the way back and you get that double bottom type scenario and it takes back 100%, but it fails to take out the key support level, which we like to call our A, right? Then you project that it's going to have enough momentum to take you to the top of the B boundary. Okay, so look, so Benny, how does this all tie in together? Once we have an AB boundary, that is concrete. It doesn't move. The only thing that can float is our C, and our C is our lowest point within the AB boundary. Write that down. Your C is going to be your lowest point within the AB boundary prior to price reversing, okay? That's going to be your C, right? It's going to form a swing low, and then it'll reverse if it's meant to do that, right? We always like to say we don't control the market, right? So you may get price to do this, right? Hit a level, right? Push up, and then push down deeper, right? Like so, like this. So that was a C, but this is our deepest C. This is our C, okay? And we'll talk about how we play that, all right? And okay, so now, so how do we do this? How do we get in these setups? Okay, well, once we get a retracement level and we get that U-turn point in the market, so right now I got a 1.618. I can project a 1.618D extension. Direction, we just formed a higher low, higher high, higher low, coming off this level, higher high, higher low. This low is higher than this low, which is our A boundary. And we get that U-turn, then we say, hey, I can look to enter here, and I can set my take profit, my long-term and my maximum take profit level here, okay? Well, where do you put your stop? Where do we protect our backside in case this trade continues down, okay? And where do we put it, right? We don't want to lose all our money. Well, what we do is we put our stop loss in. Now, a couple thoughts on the stop. A lot of traders, they'll put their stop right below the low, right? But we like to put our stop below the A and not so obvious of a position. Well, Vinny, a wider stop loss, right? A lot of stop loss, I won't be able to trade as much money. That's right. So we either got to find a way to get you more money in your account, okay? Or you're going to have to lower that lot size, all right? Give your trade room. Or if you put it here underneath a low of support, be willing to live and stomach with the losses, right? That you're going to take because you want a higher risk to reward, right? Okay, I want my risk to reward to be even higher if I run a tight stop loss. No, right? That you can get stopped out more frequently. If you're cool with that and you work your risk management out as such, then by all means do it. But we like to, right? For the fundamental concept of what we do today, we put our stop below that A. Why, Benny? Because that allows the trade room to float within the AB boundary, right? Because we have a saying that as long as price doesn't take out the A, it has no choice but to go our way, okay? So price, once it starts to retrace, can pull back within this AB boundary as much as it wants to. But if it doesn't take out the A, then there's a high probability that it's going to U-turn and go in my direction. Okay? So I got a question for everybody. Have you ever been in a trade where you're like, you know what? This is a prior level of support. I'm going to get in on this trade right now to go long. And I'm going to put my stop loss right there. If you just knew it was long, and then it did this and took your stop out. That ever happen to anybody? Right? And then you say, okay, I got this now. It looks like it's going U-turn. I'm going long. And then it does this. And then you're like, I've had it. This doesn't work. It's a scam. Or your risk management is horrible and you just blew your account, which shouldn't happen. But then when you go back and you finally get a grip on your thoughts, mindset is everything. And you go back and you say, you know what, I'm going to take another shot at this thing. And you look at the pound dollar days later, it went just like this. Has that ever happened to anybody? It's happened to me. I'm speaking from experience. All right. So for one, you got to have your risk management, right? Especially if you got to have your risk management, period, right? But you want to think about it, man. Look, this is about compounding money over time, right? It's not get rich quick. I'm not turning my account into a casino. I might want to give my trade a little bit more room to breathe, right? So no, I can't trade at $2 a pip. I'm going to have to trade this at 40 cents a pip, right? For micros, okay? The key is getting consistent. It's getting consistent and staying in the game, right? Risk percentage and all of that good stuff, okay? So this is how we do it. And we look at key areas, okay? So let me clear this out. We look at key zones, key sweet spots to trade this market. So now, how do we look to get into these trades? All right, so we have what we call our trading sweet spots. And Ryan talks about this all the time, right? Those sweet spots in the market. And to some of us, it may look confusing now, but it gets really simple because we only look for certain areas to trade. And it helps us because when you're on the charts, if you stare at it long enough, everything looks good. But that doesn't mean our account balance is going to look good in the end, right? If we don't have a strategy, all right? So what we like to trade, we like to say, okay, if my stop is below the A in this uptrend, okay, we like to say our sweet spots are at the 61.8 level and down, right? To go back to my original question of when we buy something, do we want to buy low or do we want to buy high? We want to buy for the lowest price possible. So now it comes down to the math and our risk management on this move. If we get a 61.8 pullback, we like that, okay? Not because, oh, it's the magical golden ratio, right? I'm going to tell you why here in a minute. And we also like 61.8s, right? We like 50% with structure, right? We get 50%. Some people take 382s, right? I tend not to. It all depends on your trading plan, which you'll hear us say that all the time. Well, Benny, what is this? Or should I take this trade? Or Ryan, what about this? We're going to say, what does your trade plan tell you? Okay, that's important because you need to stick to that because that's what's proven to give you your edge over time. All right, so we like to play 61.8s deeper, okay, 50s with structure. Why, Benny? Why the 61.8? Why is that important? Because of risk management. If this is a 0 to 100% move, we like for the market to take back 61.8% or deeper before we get involved with the trade because we want to put our stop loss out of the way and we want to put it below the A. Okay, so let me help you guys. We're just going to draw some boxes. So if I put my stop loss below this level and I take a trade at a 382, so I take the trade at my 382 and I put the stop loss below the A, and my projected the extension is the 1.618. Follow me. Okay, if I put my stop loss below the A, here's my risk in red. So I'm risking, this is a daily chart, okay, just to remind everybody. So I'm risking over 2,500 pips for a reward, 3,700 pips. Okay, all right. But if I wait for that trade to get deeper, look at my risk versus my reward. It increases, right? My reward increases. Look at that. Everybody see that? If I wait for the deeper retracement level, my reward is a lot higher, right? So when you hear all the time, we talk about 2 to 1s, 3 to 1s, all of this stuff. I've enabled myself to increase it, my reward versus my risk, and I also kept my stop out of the obvious location, okay? Because you could take a 382, but then hey, I move it up here, and we just went over how we can get stopped out more often. If you're comfortable with that, so be it. You take a lower win percentage versus a higher risk to reward gain. Okay, we're trying to show you how you can work yourself into having both. Okay, so if I get deeper to a 786 level, then all I'm going to do is I'm going to adjust my TP to around this 118, 127 zone, like so. Okay, and the same thing for the A6 if it goes deeper to an A6. But look at my risk versus my reward. Okay, so there's nothing magical about the 618 zone. It's just that other people know it, right? So it enhances your reward versus your risk ratio. Okay, so you could put it in there. Hey, I'm comfortable with the multiple stop outs. I like a super tight stop, or I could put it below the A, let the trade breathe, and just adjust my TP level, right? That's what we do. If we clear all of this out, it's the same thing on a downtrend, right? Price moves in waves. We pull back, we push down, right? You pull your fib out, right? We've got our A, B, C, D, A, B, C, D, right level. We pull out our fib, right? We're looking at the same thing. Price is pushing down, then it pulls back. It takes back 61.8%, right, of what it sold off. We look to get in. Look, very simple concept, right? Look, here, okay? Here. Stop above the A, okay? Based on our pullback level, the extension, right? That's it, in the opposite direction, okay? Trade floats, right? We got a direction back, right? We know where to get in, we know where to get out, and we calculate our risk from that. If you don't know these things, do not click the buy or sell button. Don't do it. If you don't know your direction, where to get in and where to get out, you don't have your risk management worked out, do not get into the war with no guns, bullets, and knives. Don't do it to yourself. Don't guess. Don't gamble. Don't guess and don't gamble. Okay? So key zones where we look to enter, either where we're going on an uptrend or a downtrend, the same concept. Why do we take the same approach every single time? Because the market moves in waves and it moves in patterns. Okay? See everybody soon.